when you look at your profit margin, whatever it is right now, do you actually know if that number is good? Not good in a vague, feels okay kind of way. Good compared to something real, a benchmark, a target that is specific to your type of business. Most business owners do not have that reference point, so they either worry about a number that is perfectly normal or they feel comfortable with a number that should be keeping them up at night. Today, I want to give you the reference point. I'm Megan Schwan, your accounting sidekick. This is the Profit Points podcast. I work with business owners who feel like they're doing well because their business is growing and they're paying their bills. But when we actually calculate their profit margin, it's 6%. And 6% in a service-based business is fragile, meaning that one slow month, one lost client, one unexpected expense, and guess what? That margin disappears entirely. They weren't doing badly because they were making bad decisions. They were doing badly because they didn't have a target to build toward. They didn't know what good looked like. So they had no way of knowing they weren't there yet. On the other side of that is that I've had clients come to me apologizing, literally, for their numbers, that convinced that they were underperforming. But then we looked and their margin, it was at 38%. They were thriving by any reasonable measure. They just didn't have context to recognize it. Benchmarks solve both of these problems. They give you something to build toward and something to celebrate once you get there. Today's profit point is profit benchmarking. Let me give you some general guidelines, and I want to be clear, these are general. They're not universal. Every business is different, and your specific industry or structure or stage will influence what's realistic for you. So for service-based businesses, the people that are like coaches, consultants, accountants, virtual assistants, designers, marketers, agency owners, you get the point. A healthy net profit margin is generally around the 20 to 35% range. Now, net profit is the bottom line number, not gross profit. Gross profit should be higher than that. But if your net profit is below 15%, you have room to improve, and you should be asking why. If you're consistently above 35%, you're performing well. However, there should be money getting reinvested strategically or ensuring that you're paying yourself appropriately. Sometimes because a margin is very high, it could mean that the owner is underpaying themselves. So take a look at that. For product-based businesses, margins are typically lower because of the cost of goods. There's more overhead. A healthy net margin for a product business might be around 10 to 20%, depending heavily on the product category and whether it's physical or digital. For retail specifically, even 5 to 10% net is considered normal in certain categories. Manufacturing is another one that typically has generally lower percentages. So taking a look at that is important. The gross margin before operating expenses is usually around 40 to 60% and is the number to watch for health and pricing decisions. For food and restaurant businesses, margins are notoriously thin. Often the net is around 3 to 9%. This is because it's typically a high cost, high labor model where operational efficiency matters enormously. So you having things run smoothly, understanding how you purchase, all of those good kind of things. If you're in food service and you're at 12%, you are doing exceptionally well. Okay, so these benchmarks, I'm just throwing all these numbers at you. For the most accurate benchmarks for your specific industry and revenue range, your best resource are industry associations. There is the IRS SOI data, which publishes average returns by industry, And there are also platforms like RMA annual statement studies, which provide detailed financial ratios by business type. But those are some places that you can look to see where those benchmarks come from. If you're working with an accountant who specializes in your industry, like we do at Sidekick, they'll usually have a good sense of what's normal and what's not for businesses at your stage. So definitely have that conversation and do a little bit of research so you can take a look. But once you have a benchmark, here's what you do to use it. Step one is to calculate where you are now. How do you calculate it? Take your net profit, divide that number by revenue, and then multiply that by 100. Step two is to compare your target benchmark to where you are currently. And then step three is to identify that gap. If you're at 12% and your target is 25%, that means you have a 13-point gap. That gap is your roadmap. Now you can start asking the question, is the gap coming from expenses that are too high? Is our pricing too low? Is revenue not consistent enough? Usually it's some kind of a combination of these things, or maybe there's efficiencies. I mean, this is where we come in at Profit Points, the Profit Points podcast. These are the things we're talking through, is like, how do we bridge that gap? How do we lower the gap of those profits, the profit points, to get closer and identify that primary driver is what lets you take the most targeted, most important, highest priority action. So your action for this next week, because you know I always have an action item, you want to look up the average profit margin for your specific industry. You can search average profit margins for your type of business and on Google or whatever. So you search average profit margin for accounting firms, small business, accounting firm type small businesses. And you'll generally find some pretty good data, or you'll come up with some kind of an average based off of what you find. Then compare it to your own margin from the last month. And then note the gap. Is it positive? Is it negative? Write down one hypothesis once you have that number for what's driving it, what's causing there to be that gap. And that's where you can dig in. That's where you'll be able to start and kind of start digging into that. You can't hit a target that you can't see. Profit benchmarking gives you a reference point, something to aim for, something to measure against, something to celebrate when you exceed it. Your business deserves that kind of clarity. And once you have it, that path forward gets a lot more obvious and a lot less overwhelming. And if you want help figuring out what healthy looks like for your business specifically, including your industry and your goals, and a plan for how to get there, let's talk. This is the kind of work we do with our Profit First implementation and coaching services. We dig deep into the numbers and help you figure out where to start and what to fix next. You can go to chatwithmeg.com and book a free strategy call where we can talk about, is this good for you? Is this where you're at? Where do you need to start looking? Go there and tell me in the comments, what industry are you in? If you drop it in the comments, I'll share a general benchmark with you. So drop your comments. And in the meantime, I will see you next week. Bye.